The 3 hidden crossover lines that actually decide when you can retire. There aren't just one, but 3 hidden crossover lines buried inside your portfolio. Most people only ever hear about the first one. The second is far more seductive than it looks. And the third, the original one, the one that existed before the retirement industry wrapped an entire business model around this topic, is the one that actually determines whether you can retire without quietly panicking every time the market drops 4% on a random Tuesday. Most investors eventually discover the first crossover. They hit it, feel relief, and then make one of 2 mistakes. Either they start coasting too early, or they reduce contributions at exactly the point when continuing to contribute creates some of the highest value returns of their entire investing life. In the next few minutes, I'm going to walk you through all 3 crossover lines. The math is simpler than most people expect. The implications are bigger than most people realize. And the story of why the third crossover quietly disappeared from mainstream retirement advice is probably less surprising than you'd like. Let's start with something that took me longer than I'd care to admit to fully internalize, even after years of being around accountants, attorneys, and people who genuinely understood how money flows in the real world. There's a phase in wealth building where your behavior matters more than your portfolio. And there's another phase where your portfolio matters more than your behavior. Most people spend their entire investing lives in the first phase not because they haven't saved enough, but because nobody ever tells them when they've crossed into the second. I think of it as an engine swap. In the early years, you are the engine. Your labor. Your discipline. Your savings rate. Your willingness to not buy the car you didn't need. That's where the horsepower comes from. Yes, the portfolio exists. Yes, it earns something. Yes, it compounds a little. But early on, the human engine is doing almost all of the heavy lifting. Then, at a very specific and mathematically measurable point, the mechanical engine of compounding becomes more powerful than the human one. That's the swap. Your job changes. It stops being, generate all the force, and starts becoming, don't interfere with what's finally working. There are 3 moments where that swap accelerates. Each one is different. Each one requires a different response. And most retirement advice only really covers the first one. If you stay with me, the third crossover also comes with a tax trap that often doesn't show up until your 70s. And by then, the best opportunities to soften it have usually been sitting behind you for decades. Here's what most people miss, even after they first hear about the idea of a crossover. All 3 lines already exist inside your financial life right now. They're simply at different distances from where you're standing. Knowing which one you've crossed, and which one you're actually trying to reach, changes almost every decision downstream. And in a few minutes, I'm going to show you why the math behind the so-called 4% rule has often functioned more like a business model than a retirement tool. But first, we need to deal with the most popular crossover of them all. Crossover 1, when growth beats contributions. This is the crossover the personal finance world loves. It shows up in conversations about coast fire, letting your money work for you, and that magical point where compounding is supposedly doing the heavy lifting. The mechanics are simple enough to fit on a napkin. At some point, the growth your portfolio generates in a year exceeds the amount you contribute to it that year. That's the first real engine swap. The machine is now adding more horsepower than the operator. The formula is straightforward. Annual contributions divided by expected long-term return. So if you contribute $20,000 per year and assume a 7% long-term return, the crossover happens at $20,000 divided by 0.07 equals about $285,714. Call it $286,000. At that portfolio size, expected annual growth roughly matches annual contributions. Past that point, the gap widens every year. You still contribute, but now compounding is contributing just as much, and eventually far more. You'll sometimes hear a rougher version of this called the 20 times rule. 20 times a $20,000 annual contribution is $400,000. At 7%, $400,000 generates $28,000 a year, comfortably above the contribution amount. That's not the exact crossover line. It's more like a buffered version of it. And that buffer matters, because here's what tends to happen in real life when people cross this first line. They feel it. They look at the numbers, exhale, and think they've arrived. They haven't. They've simply entered a new phase of the same journey. And the mistake that often follows is one of the most expensive behavioral errors in wealth building. They reduce contributions too early. Sometimes they stop entirely. Sometimes they keep contributing just enough to feel responsible. Sometimes the habit simply softens because the portfolio appears to be doing the work. That logic sounds sophisticated. Usually it's just expensive. Why? Because contributions at this stage often have some of the highest return on effort of your entire financial life. And the reason is simple. Employer match. If your employer matches 50 cents on the dollar, or 100 cents on the dollar up to a certain threshold, then those contributions are producing an immediate guaranteed return that no normal investment can replicate. There is no index fund, no ETF, no real estate deal, no alternative strategy that gives you a guaranteed 50% to 100% return on day one. So the moment you stop contributing enough to capture the match, you're not optimizing. You're leaving guaranteed money on the table and pretending it's strategy. There's a second reason this is dangerous. Crossover 1 is not permanent. It moves with the market. A 20% drawdown can push you right back below it. And if you reduced contributions the year before the correction, now you've lost both sides of the advantage. You lost the contribution flow that would have bought cheaper shares. And you lost the compounding buffer that was keeping you above the line. There's also a third reason, and this one is psychological. When saving slows down, spending tends to expand. Not always dramatically. Sometimes just quietly. The money that used to go into investments starts leaking into a nicer vacation, a slightly more expensive car, a kitchen renovation that suddenly feels reasonable, or a monthly lifestyle upgrade that never gets reversed. You didn't just stop contributing. You moved the goalposts. Now the portfolio that looked enough for your old lifestyle may no longer be enough for the new one you created after easing off the gas. So the lesson of Crossover 1 is this. It means you can breathe. It does not mean you can coast. The engine has swapped. Your job now is to keep feeding it while it builds momentum. And that brings us to the second crossover, the one many people mentally confuse with retirement itself. That confusion has cost people years. Crossover 2, when growth beats salary. Crossover 2 happens when your portfolio's annual growth exceeds your annual income from work. Your money is now making more than your job. This is the first moment where labor becomes mathematically optional, at least on paper. At a 7% return, that line sits at roughly 14 times annual salary. So if you earn $70,000, you'd need around $1 million. Why? Because 7% of $1 million is $70,000. If you earn $150,000, the number is closer to $2.1 million. The relationship is linear. Higher salary, higher crossover number. And on the surface, this feels like the real finish line. Your money makes what you make. What else is there? Here's the problem. This crossover comes with a trap. And the trap is that people mistake a peak balance for a durable income structure. Those are not the same thing. Growth is a long-term average. It is not a paycheck. It is not guaranteed annual income. It is not even guaranteed over a decade. Consider someone who crossed the second line in 1999. Let's say they had a $1 million portfolio and earned $70,000 per year. On paper, the math worked. Expected returns could replace their salary. That looked like freedom. Then the following decade happened. The dot-com collapse. 9/11. The financial crisis. A stretch of years that shattered the illusion that average return behaves like income. If you had retired at the top, assuming your portfolio would calmly deliver what the spreadsheet said it should, then what you thought was income would have quickly turned into something else. Principal drawdown. And you might not have realized it until the damage was already underway. That's what makes Crossover 2 psychologically dangerous. A peak balance feels like proof. It feels like safety. It feels like the number has done its job. But sometimes what you're looking at is just a temporary high watermark that won't return for years. And if your retirement plan depends on portfolio growth behaving smoothly, a bad sequence of returns can break that plan early even if the long-term average still looks fine on paper. That is the real issue. Not portfolio size alone. Portfolio structure. A high balance without a reliable income structure is not true independence. It is a favorable market environment masquerading as retirement readiness. And the retirement planning industry, which often centers its advice around balances, withdrawal rates, and probability models, tends to blur those categories far too easily. That's why the real question changes at Crossover 2. It stops being, did I save enough? And becomes, is my income structure durable enough to survive a bad sequence? That is a very different question. And that question is exactly what the third crossover was built to answer. The structural problem most retirement calculators ignore. Before we get to Crossover 3, there's a distinction you have to make. Most retirement calculators model average returns. Real retirement happens in actual sequence. That difference matters more than most people realize. A retiree does not receive the market's average return in a neat, smooth line over 30 years. They get whatever order the market happens to deliver. And the order matters. A bad decade at the beginning of retirement is far more dangerous than a bad decade at the end. That's why average return can be a deeply misleading comfort. You can absolutely get the average and still get broken by the sequence. That's what most people miss when they assume a balance number automatically equals safety. It doesn't. Which brings us to Marcus. Marcus, a balance that looked safer than it was. Marcus is 47. He's a software engineer in Austin. He started investing seriously in his mid-20s, lived below his means, maxed contributions for years, and by 2022 had built a portfolio of around $1.3 million. He earns about $92,000 a year. At a 7% return, his portfolio was generating roughly $91,000 in annual growth. He was essentially standing right at crossover 2. From the outside, he looked close to done. And like many people in that position, he started to feel like the hard part was behind him. He didn't stop contributing entirely. He still contributed enough to get the employer match. But the extra, more aggressive savings that had defined the previous 15 years of his life stopped feeling urgent. Then 2022 hit. His portfolio fell to around $950,000. Not a disaster. Not life-ruining. But enough to push him back below the line he thought he had crossed. And in that moment, the illusion became obvious. He hadn't built a durable income structure. He had reached a favorable balance. Those are not the same thing. Marcus is fine. His portfolio recovered. He kept working. He'll likely do very well. But he made the classic mistake. He confused a high balance with a reliable engine. And that confusion is exactly what Crossover 3 helps solve. Crossover 3, the original definition. Crossover 3 is the original crossover. Not the simplified version the retirement industry popularized. Not 25 times spending. Not 4% withdrawals. Not a big enough nest egg. The original definition comes from Your Money or Your Life, the 1992 book by Vicky Robin and Joe Dominguez. In that framework, the crossover point was simple. The moment your monthly income from investments exceeds your monthly expenses. That's it. Not annualized growth. Not total return assumptions. Not what your balance might do next year. The question was, do your assets produce enough recurring income to pay your bills without you having to sell them? That is a fundamentally different framework. And mathematically, it changes everything. Let's say you spend $40,000 per year. If your assets produce a 5% income yield, then you need $40,000 divided by 0.05 equals $800,000. At a 7% yield, the capital needed falls to roughly $40,000 divided by 0.07 equals about $571,000. Compare that to the classic 25 times spending rule, which says you need $1 million to support $40,000 of annual spending. That is a very different target. More importantly, it's a different mechanism. In the income-based model, you are not depending on selling assets into whatever market conditions happen to exist that year. The income pays you. The capital remains in place. That is the distinction. And once you see it, you start to understand why this version quietly faded from the center of mainstream retirement advice. How the 4% rule took over. 2 years after Your Money or Your Life was published, financial planner William Benjen published a paper in 1994 examining historical withdrawal rates. His conclusion, simplified over time, became the 4% rule. A retiree who withdrew roughly 4% in year 1, then adjusted that amount for inflation each year after, had historically survived a 30-year retirement under the data he studied. That finding became gospel. But here's what often gets lost. It was never meant to be a universal golden rule. It was a conservative guideline derived from a specific framework and a specific historical method. Over time, even Benjen himself has made it clear that the number was never intended to be treated as a one-size-fits-all commandment, and that higher withdrawal rates may be reasonable under different assumptions and asset allocations. But the industry did what industries often do. It took a conservative floor, turned it into a rule, named the rule after the number, and built an advisory model around it. That changed the whole conversation. The focus shifted from, how much recurring income do your assets generate? To, how large is the portfolio, and what percentage can you safely withdraw? That shift matters. Because once the framework becomes portfolio size driven, an entire fee-based planning ecosystem fits neatly around it. And that brings us to incentives. Why the industry prefers the balance question. A large part of the advisory business is built around assets under management. The larger the portfolio being managed, the larger the advisory fee. That does not automatically mean bad intent. But it does create a structural bias. Take a simple example. A client has $200,000 in a managed portfolio. The advisory fee is 1% annually. That means the advisor earns $2,000 per year from that slice alone. Now imagine the client says, what if I move that $200,000 into a rental property, a CD ladder, or secured notes that generate income outside the portfolio? From the client's perspective, those dollars are still working. From the advisor's revenue perspective, they just stopped generating fees. That incentive may not be discussed directly, but it exists whether anyone says it out loud or not. So when clients ask, what if I just live off dividends, bond income, rents, or note payments instead of selling shares? The conversation often drifts back toward allocation models, safe withdrawal rates, and keeping assets inside the managed framework. Again, not necessarily because anyone is dishonest. But systems tend to steer people toward the logic they are built to monetize. And the income-based crossover sits partly outside that system. That's the uncomfortable part. Because income-producing assets behave very differently from growth assumptions. Dividend-paying stocks still distribute cash when prices fall. Bond coupons still arrive on schedule. Rental income can continue during equity drawdowns. Secured notes pay according to contract terms. These streams are not perfect. Each carries its own risks. But they are structurally different from relying on market appreciation to fund living expenses. And that is why Crossover 3 is the only one of the three that is fundamentally built to survive a lost decade better than the others. Marcus revisited the dashboard change. After his 2022 drawdown, Marcus asked a different question. Not, what is my balance? But, how much did my assets actually pay me last month? Dividends deposited. Interest received. Cash that arrived without selling anything. The answer surprised him. About $2,200 per month. His monthly expenses were around $3,800, which meant he wasn't near full independence in the way he thought. He was at roughly 58% of Crossover 3. That changed everything. Because for the first time, he stopped using net worth as the primary scoreboard. And that's the shift. Net worth is a market number. It moves every trading day. Monthly asset income is a lifestyle number. It tells you how much of your real life is already being funded without labor. That is the number that matters if you're trying to retire without constantly wondering whether the next correction just changed your future. So here's the real dashboard switch. Stop treating balance as the headline metric. Start measuring the income your assets actually produce. If you can answer the question, how much did my portfolio pay me this month without me selling anything? Then you've started aiming at the third crossover. And once you start tracking that number, retirement looks very different. The tax trap waiting in the background. Now we need to talk about the trap that often appears later and usually too late. Because even if someone builds a large portfolio, they can still get blindsided by the tax structure of that portfolio in their 70s. This is where required minimum distributions, or RMDs, come in. Under current law, owners of traditional pre-tax retirement accounts such as IRAs and 401(k)s generally must begin taking required minimum distributions in their 70s. And once those mandatory withdrawals begin, it may not matter whether you need the money or not. You still have to take it. That single number, the annual RMD, can create a chain reaction. A larger RMD can increase the taxation of Social Security, push you into higher income brackets, and trigger higher Medicare premiums through IRMA. So one forced withdrawal can quietly increase multiple bills at once. That's why this is not just a withdrawal issue. It's a structure issue. And structure decisions made in your 40s and 50s can have consequences in your 70s. The good news is that the solution is usually not mysterious. It just requires acting early. That can include doing Roth conversions in lower income years, directing contributions beyond the employer match away from pre-tax accounts, building more assets in Roth or taxable accounts, increasing the share of future retirement cash flow that comes from tax-flexible sources instead of fully taxable forced withdrawals. People who avoid the RMD trap are not necessarily smarter. They just started thinking about income structure earlier. That's the difference. The balance question is what most people check every quarter. The structure question is what determines whether retirement actually feels stable. Dana, same savings, two very different outcomes. Let's make this concrete. Dana is 51. She's a project manager earning $85,000 a year. She started investing at 31 and now has $800,000 in a traditional 401(k), plus about $90,000 in a taxable brokerage account. Her monthly expenses are about $4,200. On the surface, she looks in decent shape. But her current retirement plan assumes she'll use a standard withdrawal strategy. 4% of $890,000 gives her about $35,600 per year, or roughly $2,967 per month before taxes. Her expenses are $4,200 per month. So even before accounting for taxes, she has a shortfall. Her tentative solution is to claim Social Security early at 62 to fill the gap, permanently reducing the benefit she'd receive compared to waiting longer. She also hasn't thought much about future RMDs, even though her pre-tax account is likely to be much larger by the time mandatory distributions begin. Now imagine the parallel version of Dana.
Same age. Same income.
Same starting savings.
But at 51, she changes the frame.
She still contributes enough to get the employer match in the 401k, but additional dollars start going toward a Roth IRA, taxable investments built around income, and safer near-term cash flow tools. She creates a short-term CD ladder inside the taxable account. She allocates some capital toward other income-producing assets. She gradually shifts part of the taxable account toward dividend-focused funds. By age 58, her income-producing assets are generating roughly $1,400 per month without requiring her to sell shares. She still hasn't reached crossover 3. But now she has a live metric. She knows exactly what percentage of her monthly life is being funded by assets. And that changes both the plan and the psychology. She is no longer staring only at a balance and hoping it translates. She is building an actual income machine. At the same time, because she shifted some future savings into Roth and taxable structures, her eventual RMD burden is smaller. That gives her more flexibility with Social Security timing, less pressure to claim early, and fewer unpleasant surprises later. The structure did work the balance alone could never do. The 3 crossovers, clearly. So here they are again.
Crossover 1.
Your portfolio's annual growth exceeds your annual contributions. If you contribute $20,000 per year and assume 7% returns, this happens around $286,000. This is the point where you can breathe. It is not the point where you should coast. Keep contributing at minimum enough to capture every dollar of employer match. Crossover 2. Your portfolio's annual growth exceeds your salary. At 7%, this happens at roughly 14 times income. For a $90,000 earner, that's a little above $1.28 million. This is the point where work becomes mathematically optional on paper. But a high balance is not the same as a durable retirement structure. If your plan depends on growth behaving smoothly, a bad sequence can expose the difference very quickly.
Crossover 3.
Income from your assets covers your monthly expenses. This is the original crossover.
The Vicky Robin version.
The one based on cash flow, not portfolio mythology. If you spend $40,000 per year, that might mean $800,000 at a 5% income yield or less with higher sustainable income generation. This crossover is usually less glamorous, but far more grounded. Because it focuses on the one question retirement actually has to answer. What pays the bills? Not what the statement says. Not what the market might do next year. Not what average returns looked like in a planner's Monte Carlo chart. What pays the bills? 3 practical moves from here.
First,
if you've crossed crossover 1 but not crossover 2, stop obsessing only over how much your portfolio is worth. Start asking, what does it actually pay me each month without me selling anything? That question will improve your decisions faster than balance watching ever will.
Second,
if you are within 10 to 15 years of retirement and most of your wealth sits in pre-tax accounts, model your future RMDs now, not later.
Project the account forward.
Estimate the forced withdrawal. Add it to expected Social Security and other income. If that combination creates tax pressure, bracket creep, or Medicare premium issues, you still have time to do something about it. Later is more expensive.
Third,
build a simple dashboard that tracks monthly income from assets.
Not just returns.
Not just account value. Actual cash flow.
Dividends. Interest. Rents. Note payments.
Any money that arrives without liquidation. Because the moment you start measuring monthly asset income instead of only market value, your thinking changes. You stop asking, how big is the pile? And start asking, how much life does this pile already fund? That is the mental shift that moves you toward real independence. And it is one of the clearest signs that you're finally aiming at the right crossover.
Final thought.
Most of the retirement advice people receive is built around a framework that became dominant in the mid-1990s, got simplified into a slogan, and then turned into an industry standard. A conservative floor became a rule.
A rule became a brand.
And the brand became the default answer to one of the most important financial questions of your life. Meanwhile, the older and in many ways more practical question got pushed into the background. Does your money produce enough reliable income to support your life without requiring you to keep selling pieces of it? That is the real question. The engine is already there. Most people just never get told which dashboard to watch.